So now we are looking at the principles. So the principles we are now on objectivity principle. This principle simply asserts that all financial and accounting information of a company should be independent and be based on evidence that is verifiable. This means that the information that you must have what? A reliability aspect. Okay, it must be based on factual information. Then there's what we call the revenue realization principle, which simply asserts that once you set a price for a particular commodity that you're supplying, you should record that particular price soon as the delivery is made, not when the money is paid. So this realization principle simply asserts that for any good or service, it means that you only realize the revenue and record it once you deliver, once you do what is called or produce a delivery note. So what is called the matching principle. This is also called the accruals principle. It says you can only charge costs in the period that they were earned or accrued. For instance, even if you have rentals that are due this month, by virtue of you not paying them, does not mean you should not charge them. It is an accrual, charge them. Then we have what is called the consistency period principle, which simply means that accounting has what are called accounting standards. We have the SIs that are there, International Financial Reporting standards. So once you adopt a particular standard or practice, you need to make sure that you use a particular reporting standard, not here use this format, here the other format. So you need to be uniform. There's also what we call the disclosure principle, which simply asserts that a business must provide all relevant facts of information in its financial statements, and must also provide accompanying notes that will enable the reader make use of them. Then we also have what is called the prudence principle, which means that you need prudent carefulness or caution or good judgment. So this principle simply states that we should be cautious or prudent whenever we are reporting our financial information. For instance, if a situation arises where there are two acceptable alternatives for reporting an item, it would be better that you choose the alternative that will result into less net income or less asset amount. This principle makes sure that you do not estimate your assets or underestimate your liabilities. So it is a very important principle. Okay, so now what have we learned? So we've talked about what? The entity assumption, where the owner must separate the affairs. Going consent, we talked about it, where business should remain in operation for a foreseeable future. Periodicity, you report your financial results within a designated period of time. Okay, what else have we talked about? Historical and the prudence concepts. The other concept we've talked about are consistency, where you need to adopt one accounting method throughout. Disclosure, where you need to provide all necessary information needed. Prudence, where you don't need to overstate your assets or understate your liability. So this is usually done by people who want to avoid paying tax. So the prudence concept simply says you must what? You must take note of I hope these are all clear. Okay, so a quick, can you remember? So we're going to apply the principles. The statement or transaction of a business should be recorded. What accounting principle is this? Full disclosure. Brand Bell
Yes.
business. However, Brand Bell is not around until the existence. What is this?
Going concern.
Going consent, yeah. Full disclosure here. Accounting reports must be reported every year.
Periodical.
Personal affairs must not mingle with the business.
Entity, separate entity.
Separate entity, yeah. Revenue and must agree with the cost incurred.
Matching principle.
Matching principle, okay, or accruals principle. All right, good. I'm glad. So I'll send you this is a simplified module where you go through.
Okay.
Yeah. So the next class we're going to have, we're gridding the week, which days, because I wanted to finish unit 1, 2, 3, then units 4. That's where the calculations start from. But
okay.
Quickly, read through as much as you can, so that the basics of the theoretical part, you understand what journals are, what ledgers are, so that as I start the calculations, we now go into calculations. So if the timeline is very good, we might even finish by next month or by month end, because I want to particularize you guys so that we can be efficient. And if possible, we now look at the exam questions ahead of time. Yeah.
Yeah, that will be good.
All right. Thank you so much.
All right. Thank you. So I'll be waiting for this one.
All right. And I'll send you the video as well.
All right. Thank you.
All right.